Hey guys, Jay here. This is smarthelping.com, and today we've got an accounting template for absorption costing. And we're going to do it for one period, and the main goal of this is to figure out the cost per unit. It's quite detailed to fit as many situations as possible. And we've also got, once we fill in all our data, which I'll do with you right here in the video, we've got absorption cost summary, which will be by unit and in total. And we've also got an example of a financial statement assuming some selling price. And you can see operating profits given the assumptions. And then we've also got a break-even analysis, as well as a sensitivity table down here. So there's quite a lot of mental fortitude went into getting this thing built correctly. So let's go through it. And the best way to see how to use these models is often just watching somebody actually put data in and explain it as they're going. So that's what I'm going to do here. And obviously downloading the template is possible by going to the link in the description or just check out smarthelping.com in the accounting section. Okay, so let's start with the units produced. So let's say in a given period, whatever that might be, it could be a year, a month, whatever, it doesn't matter. Just in whatever period, let's say we're going to produce 5,000 units of something. And let's say in that same period, we're going to sell, and the selling is only going to be relevant for the income statement, but not really the absorption costing. But let's just say we'll sell 3,000. Okay, now the first part of absorption costing, you're going to look at direct costs. And within the direct cost section, we have a bill of materials breakdown. And we break down bill of materials based on a set of raw materials, if relevant, sub-assemblies and components, packaging materials, and consumables. Once we figure out all of that data, we have a total essentially bill of material cost per unit. The other part of this costing model is going to be direct labor hours, and we have 13 relevant fields here, and this is labor wages. We do account for efficiency, and then so that's all of the section 2, which is the direct costs. We also have manufacturing overhead to account for, and there's a variable manufacturing overhead. There's also fixed manufacturing overhead. And so we'll fill out those sections. That's where things get a little bit trickier. So we'll walk through how it goes and how it flows down to the costs accordingly. And then after we have those, the only thing left is there is an input for variable selling costs as well as the selling price per unit. And then there's assumptions for fixed selling and administrative costs that would be, so we can figure out what our operational net income is for the period. This part's not really for absorption costing, but it's just a layered on piece that kind of you might want to see as a result of the absorption cost summary and its relevant outputs, and you apply it to some sales volume and price. You want to see what profit you might make, as well as seeing the break-even units produced, break-even revenue of the based on the given assumptions, as well as a break-even price. And this you'll see will really go in a couple circles when I try to explain this. But let's start. So that's the layout. Let's actually fill some information in because that really helps people see. So let's say we have raw materials. Let's say steel is going to be, we'll measure it by, let's say you need three, for a given unit, it's $3 a pound. I'm just making up numbers. And freight is going to be about 50 cents a pound. And there could be other raw materials that go into making your product. There could be any number. So you just put in the unit cost here, and then we put count per finished product. Let me expand this column a little bit. So that just means how many of these, let's say you're buying a $3 a pound, how many pounds of steel do you need to complete a single product? Let's say maybe it's 2 pounds. So on that one, we have $6 a unit. Now, scrap rate is going to say if this unit count here is 2 and it is not accounting for, let's say you have to cut the steel, and so you're buying, let's say, let's just say, for example, a 2 foot by 2 foot square, but you're not going to use the full 2 foot by 2 foot square. You're going to use a little bit less. Well, you have to account for that here, so you could put a scrap rate of, let's say, 5%. And so in reality, to make 1 unit, it's going to cost you a little bit more. Here, if it's 5% scrap rate, it's actually costing you $6.30 a unit. Because you're paying for that extra little bit. You know, it's not, if you're not, now if it's a 0% scrap rate, that means whatever you're paying for here, it's exactly what you need for a given unit. And then let's say here, inbound freight, so 50 cents a unit, and we'll say 1 unit here. So every unit you're paying 50 cents. Scrap rate could be relevant if you're, again, if what you're buying is, you know, you have to actually get a little bit more to cover the full unit. You can put a scrap rate on there. And so at 5,000 units produced, we are at $31,000 total cost for steel, $2,625 for inbound freight. Okay, so let's move on to the next section. We have sub-assemblies. So let's say we have one item that is $25 a unit, maybe another item that's $10 a unit, and we need 3 of these and 2 of these. So per unit, $75, $20 a unit. Total cost at 5,000 units produced, $375,000 and $100,000 respectively. We go down, packaging materials, maybe boxes, maybe 70 cents a unit. And we'll just say each unit we need 1 of these. Labels, maybe 25 cents, and maybe 2. Materials, you know, other packaging materials and such could be 10 cents, maybe 15 cents here. So there's those costs per unit and total cost given those volume. Consumables, maybe special adhesives, say 75 cents, $1, 50 cents, and we'll say 2, 1, and 4. Okay, so there's that. All in all here so far, we have $107 cost per unit. If we add up all these, and we have a total cost at 5,000 produced of $538,875. Okay, so that's the top section, and I did put groupings so you can minimize these if you want. It kind of makes it easier once you've filled in your data, and you can still see the summaries of what it's costing you per unit for each of these sections. So that's the bill of materials. Now let's go to direct labor hours. So here we're trying to allocate, you know, what does it cost to pay people directly working on putting the product together. So let's say, you know, these guys have wages. Let's say, you know, $25 an hour, 35, 20, 40, and $30 an hour. And this is average wage. So if it's a overtime, you want to do a weighted average of, you know, essentially how many hours you worked at regular versus how many hours you worked overtime, and just weight the overtime rate and the average rate based on the number of hours. I did the math here for you so you could see how you want to calculate that. So this is what you want to do on the average rate. Also, if you're not accounting for in the fixed manufacturing overhead, payroll taxes, and insurance and benefits, either it's going to be here or you want to include it in the wages. So whatever that is, let's say it's 20% of their base wage, you want to increase that amount by that because that's what your company cost is. Then we have standard time. So this is hours spent per unit. So for example, the laser cutting. This person's $25 an hour, and on a given unit, how much time are they spending per unit? Let's say 0.2 hours. And then let's say for CNC machining, maybe, I don't know, 45 minutes, so 7.75 hours. Polish, maybe 0.1 hours. Subassembly, maybe zero point 0.5, half an hour. And then testing, maybe 0.3 hours, 20 minutes. Okay, so we have the allocated time. Now we have an efficiency factor. So let's say if this was 100% efficient, then they are exactly, essentially it's taking them exactly as long as it should. Let's say they're 95% efficient, then it's actually taking them a little bit longer. So let's say these guys are all at 90% efficiency. So our real effective time and cost per unit is then calculated. So all in all, for a given single unit, based on this amount of time being spent per unit, it's costing us $69.16 per unit in direct labor hours. And with 5,000 units, that's $345,000 in direct labor. And now that we have all of that, we can add up our total bill of materials costs. So raw materials plus direct labor, and we're at $176.94 a unit here cost, a total $884. And these all directly change with the volume. So if I did 4,000, well, the cost per unit won't change, but the totals will here. But you'll see how that can affect, well, once we get going on the other part. So this, the cost per unit doesn't change, but that's why you're breaking this down into cost per unit, so you can apply a number here and see how much the total cost is. Okay, so those are all the direct costs. Now we have manufacturing overhead. So manufacturing overhead, there still is variable costs there, meaning variable just means it directly correlates with the volume produced. So in this section, it's more like an activity-based costing style. So we're going to say, let's look at indirect materials. Let's say we think indirect materials, it costs $10,000 per unit, or our driver is units, and then we want to put what's the budgeted driver quantity. So let's say it costs $10,000 in direct materials, and our units, and what do we get out of that? Maybe, let's say, 1,000 units. So we break this down and figure out what's our cost per unit for indirect materials. Here's $10. And we're going to carry that down into this other section here in a second. Let me put the rest of these. We'll say indirect labor variable. So this is an interesting one. Here we're saying our driver's direct labor hours, and we're saying, let's say we put 20,000 here. And that gets us how many direct labor hours for $20,000. Let's say, this is data you would get from your system, but let's say, well, if we let's divide this by 35, or 30 actually. Say 666 hours. Okay, so that on average $30 per direct labor hour. So what we're saying here is for every direct labor hour, which is calculated right here, if you open up the direct labor, we're spending around 2 hours per unit. If you look at all these times, we're saying for every 1 hour of this, it's costing us $30 in indirect labor. So we're figuring out the cost per the given unit, and then applying that to what it costs per unit for whatever that is, and then we'll calculate that down here for the cost per unit for variable manufacturing overhead. Okay, so again, we're just saying indirect labor 20,000. We want to figure out for every one unit produced, how much are we spending for direct labor? And you'll see it'll come together down here. All right, machine electricity and machine maintenance. So here I've made a note, or a bullet, or a little star you'll see at the bottom. But let's say it costs $5,000 in electricity and maintenance. Let's say $2,500 per machine hour is our driver, and so we're going to say, well, how many machine hours do we get? Or, how many machine hours for $5,000? So let's say this gives you, we'll say 800 hours, and then maybe 1,500. So here now we're breaking down the cost of machine hours into cost per hour, so $6.25 per machine hour, and then down here we're going to figure out okay, what's our driver quantity per unit? So how many essentially machine hours are active to produce one unit. Here's going to be how many units of direct labor are there. Well, we'll get to it in a second. Let me put this last one in. QA testing. This is again measured in units. So anything measured in units, we'll put a 1 down here. And these, I'll explain why in a second. Let's say QA testing, 10,000, and let's say you get 20,000 units out of that. So it only costs you 50 cents a unit in QA testing. Okay, so these two are already broken into units as their driver. So we just put 1 here because we're saying it costs $10 per unit. Okay, so there's no need to change or convert this to anything else. The rate is just $10, and every unit, that's per 1 unit produced. And then same with the last one, 50 cents a unit based on this. In this, you're saying you can get 20,000 units inspected for $10,000. Now, the tricky part, let's look at indirect labor. So you can see this is auto-calculated. So indirect labor, we know it takes 2.056 hours for 1 unit. Okay, and here we're saying it is $30 per direct labor hour of indirect labor cost. So for every 1 hour of direct labor, it's costing us $30 of indirect labor. So in total here, it's $61 per actual unit produced. Why? Well, here we're saying at $20,000 we can get through 666 units, result in $20,000 of indirect labor. And then we say, okay, so that's $30 per direct labor hour. It takes 2 direct labor hours per unit, so it takes $61 of indirect labor. And these numbers you could change to fit your situation, whatever it might be. So $61 a unit, $308,000 here. Now the 2 machining, these ones are pretty easy. It makes a lot of sense. So what we want to do is allocate the cost of electricity and maintenance for the unit by unit. So what do we put here for the driver? Well, we know here we're saying machine electricity is $6.25 per machine hour and $1.67 per machine hour for maintenance. But how many machine hours go into 1 unit? Well, there, a simple calculation down here at the bottom. We could say, well, look at this. We do laser cutting, CNC mill, press brake, paint booth, cutting or curing oven. So for every unit that touches all of these things, it takes a total of 1.02 hours. These are all measured. This is all hours. You can put a utilization, and you get the total effective machine hours per unit. Let's make those wrap text so you can see. And I got some explanations here, but we're now saying for every single machine hour, it's 1.11 machine hours for a single unit based on this. So we go up here, put 1.1, was it 1.1 or 1? 1.11 actually. Okay, so there you now have your total cost per machine hours per unit. So it's costing you $6.90 per unit produced in electricity and $1.80 per for maintenance per unit. And again, maybe it's driven off of this here. If $2,500 of maintenance, you can get 3,000 machine hours, and that will lower your cost. There we lowered it to 92 cents. And let's say maybe electricity, $5,000 of electricity, maybe you can get 2,000 machine hours out of, or it costs you $5,000 in electricity for 2,000 machine hours, so that lowered that cost a little bit. For 5,000 units, those are our two costs there, 13,004 and this 277 unit and 92 cents a unit. Okay, so that's variable manufacturing overhead. Hopefully I explained that well. Basically, you have the top configuration to figure out, this is your application rates to figure out what you're going to apply down low, and then your actual cost per unit here is calculated by the number of whatever your driver quantity is per unit here. So, again, indirect materials, it's 1 because it's just we're measuring it in units here already, but the middle 3 we're converting. So this is 2 direct labor hours, 1.1 machine hour, 1.1 machine hour per unit produced. And this is what the cost is for this in this denomination, and then conversion, and then we apply it to get the total cost per unit here. All right, fixed manufacturing overhead. So this one is a little tricky. Okay, so think about, we're doing absorption costing. So the goal of absorption costing, you want to know what's your cost per unit when you account for everything directly related to producing your product. And you even, depreciation can be a cost of goods sold of the equipment that's being used. So that is definitely, part of your cost per unit. The factory rent, common area maintenance, insurance and taxes, let's say base load utilities like lights, keeping the lights on. So what we want to say is in the given period here, whatever period we're measuring, we could say our depreciation is, let's say, $20,000. Factory rent in whatever, again, this is very important, this is whatever period we're measuring this unit produced in. It could be a month, a year, a quarter, whatever, it doesn't matter, it just has to be consistent. So let's just say it's a month, so we're spending $20,000 in depreciation. Factory rent, maybe 5,000 or maybe 10,000. Insurance and taxes, let's say 3,500, and then lights, let's say 1,250. And our driver here, and you can put whatever driver you want, but here we're saying this is direct labor hours. That seems to be the best way to figure out your essentially what you're spending. So, and we already calculate the direct labor hours up here in this section. So we know for every 1 unit, it takes 2.056 direct labor hours. And then we go down here and say, okay, so if depreciation costs $20,000 in the period, we're saying our drivers, direct labor hours, our budgeted driver quantity. So this says how many direct labor hours happened in this period. So you can see here, this is just multiplying the direct labor hours per unit times the total units produced. And that tells you, okay, in this month, we spent 10,278 direct labor hours. And so all we're doing here is saying, oh, these costs all happened during that period. So we divide, and you can see the calculation here. We're dividing the cost by however many direct labor hours happen. So this says essentially a dollar is costing you $1.95 per direct labor hour in this period for depreciation. It's costing you almost 97 cents for factory rent and so on. And what it all this ends up doing is this, because you can do it another way. You can manually define this driver and then have the conversion down here, but it gets really difficult when you get down to the break-even calculations. If you want to do break-even, it works fine for the absorption cost and the unit costing, but I found this is the most consistent way, and it's you can get some really good insights if you use this logic. So that's why I liked it. But essentially, we're saying no matter how many units are produced, this is your cost for the period, which should be true. This cost for the period should not change with the unit count. And so this sets it up so we're always solving. You can see here our driver quantity is the direct labor hours per unit. And remember, our budget driver quantity was the total unit, direct labor hours times the total units produced. So that will always result in our total cost being whatever this is here. And our cost per unit, now this is where, so let's say I do 4,000 units produced. Okay, before I hit enter, the cost per unit, what's going to happen to it? Well, we're lowering our units produced, but we still have the same fixed overheads here. Depreciation, factory, no, that doesn't change for the period. Okay, so if I produce less and it still costs the same, my cost per unit should go up. However, my total cost should stay exactly the same. So let's see, this one's $4, $20,000 total cost. Now I'm $5 a unit, but it's still $20,000 because now my rate here, the predetermined rate that we're calculating, is now, instead of before it was $1.95 in depreciation of equipment per direct labor hour at 5,000 units produced. Now at 4,000, it's gone up to $2.43 per direct labor hour for depreciation. So I was raising my cost per unit since I produced less, and we're getting the total cost per unit for fixed manufacturing overhead here and the total cost here. Okay, that took me a while to figure out the best way to set this up, but that's how we got that. And now, if I minimize all the stuff up top, we now have an absorption cost summary. So we can see in direct materials, it's costing us $107 a unit. And direct labor is costing us $69. And variable manufacturing overhead is $75. Now those are the three variable items. So we say, okay, that our total variable cost is $252. And then if you were going to go and calculate, you can see in the break-even analysis, we have contribution margin, which is a little bit different. That takes all variable, and then you get to the contribution margin, and then you take fixed costs after that. The absorption costing, we're just saying, here's your variable cost, here's your fixed manufacturing overhead per unit, and then we just have this main thing, which is our cost of goods sold. And that's why it's important to note this is different than, some income statements. It depends on how they're set up, but this is cost of goods sold, but that's not a contribution margin because you're adding the fixed overhead here per unit. But this is a cost of goods sold, the direct depreciation expense of the equipment. So that has to be included in your cost per unit here. So we're saying whenever you produce one unit, costing you $261. In this case, to produce 4,000 units, it's costing us $1,046,000. Now, if I start raising this, let's say 10,000, our cost per unit goes down a little bit. And why is it going down? One reason: the fixed manufacturing overhead cost. So if I only produced, note the total cost is still the same, $34,000 for that, but the cost per unit is different. So 5,000, you're at $6.95. If I did double that, 10,000 units, now it's only costing me to produce a unit half of that in my fixed overheads. So that's there, and that's what's going to affect this final absorption cost per unit. And that's really useful because to get your cost of goods sold, you just multiply the units sold times this, and that's your cost of goods sold. Now, if we know it costs $256 to produce one unit, and there's still potentially other costs here. We have, potentially fixed selling administrative costs as well as a variable selling cost. We want to charge more than $256. So let's say we want to charge $350 a unit, and maybe there's some selling costs there of, let's say 3%. Okay. Now we have, and let's say also our inputs here, let's say there's some employee salaries, and again, this is all has to be for this period that we're tracking all these other calculations on. So the same period. What's our overheads here? Maybe 7,000 for that. 10,000 for this. 6,000 here. And so on down the line. I just try to put a lot of slots so you guys have plenty of room to put stuff in. There's 32 of them here. Okay, I'll minimize this. So now what do we have? Well, at $350 a unit, if we sell, so we produce 10. Let's say we only sold 3,000 units though for now. Okay, so that's $1,050,000 in revenue. Our cost of goods sold is $769,000, which is just the cost per unit here times this. Now you'll note this. Why are we not at 2.5 million here? Well, we didn't sell all 10,000. If I did sell 10,000, then you'll see this 2,563,000 will pop on down here. There it is, 2,563. That might be easier to explain this anyway. So let's just say that's the amount sold. Our gross profit is 936,000. 26% margin. Now we still have the variable selling costs and the fixed costs, and then the total here we go from to 128. Operating income or net income $808,000. 23% margin here. This is pre-tax, and that's a good spot to start with. This is you can figure out all your different costs, figure out your sales or unit volumes here, and know what potential, and you can adjust all these different things to see how it affects the bottom line. Let's put this back to 3,000 units. And you got your example income statement. Now where it gets even more fun, we have the break-even analysis. So let's look at this. So here's the break-even check. So this just says, okay, this break-even units produced is saying, well, at 10,000 units, we're making a profit of 226. But how many units do we produce? Or how many units, if we produce a certain number of units, what is that number of units so that we break even exactly? And that's what this number says. So if I were to copy this over here and paste it into here, and now this is not break even because I'm selling 3,000. So let's put this back in here as well for units sold. Boom. So we know, okay, I sold produced 667, sold 667. I've broken even. Now if you sell less, you're now at a loss. If you sold more, you're a slight profit. But that is the break even. So we know, okay, I have to produce, and this is the most important thing because it's telling you, based on all these different cost factors, how many units should you produce within this period so that you at least break even, and that number is 666. And you're breaking even. And that's assuming you're charging $350 a unit, 3% selling costs, and all those other costs here. And here's our check, so we could say, okay, well, if we did 660 units at $350, it's $233,000 in revenue. Our direct materials cost is $71. Direct labor is $46,000. Variable manufacturing over at $50. Variable sales and administrative $7. Total variable cost $175. Contribution margin. So the contribution margin is your total revenue minus all the variable costs, $57. Then we have our fixed cost down here. And remember, fixed manufacturing overhead is calculated up there, but it's always the same amount in the period, $34,000. The cost per unit could vary. And then fixed costs here, this is just hard-coded inputs in the income statement, 23,000, and those equal the contribution margin here. So we are breaking even exactly on the check. And then this is showing the per unit values that are corresponding here. And then we can go down to essentially contribution margin on that. And then down here is your break-even units, break-even revenue, 233,000. Now, let's take it, well, before I get to the break-even price, let's talk about the sensitivity table. So here it shows you, based on all these assumptions, it says, in assuming this is how many units you produce, so your cost, your fixed manufacturing overhead is going to be a big factor here. So how many units you sell under these circumstances at different prices, which are P&L. So we're at a negative. Why are we at a negative right now? Well, because we are saying this price is $350. We're testing prices from $40 to $80. So we know that's all going to be negative because we're just breaking even at 350 unit at 667 units. Now, let's say we produce 10,000 units. You're still negative here. It's just the price isn't enough. Now, what's interesting, I can then follow up here and say, okay, what's my break-even price? Well, we know it's 350 because we've solved for the break-even units already at this price. But let's say the price was $75. Okay, now we're at a negative because our cost per unit is 304. So we put in a price that's lower than our cost per unit. So I'm not, let's say you produce 10,000 units now. Okay, didn't lower it a whole bunch. Let's say 50,000. Okay. Still not, $253,000 or $253 a unit. So let's say this is 275. Okay, under these circumstances, at $275 a unit, the sensitivity table is not going to be that helpful. So let's look at 125, 175, 200, 225, and 275. So now I can see, okay, I know 275 is profitable a bit. My break-even price under these circumstances is 261. So you can see somewhere between this, let's say I put this at 260. 262 at 50,000 units. So this needs to be... So you see I broke even right between these two here, which I know I should because this is my break-even price per unit if I produce 50,000 units. Now, what if I produce 10,000 units or sell 10,000 units at these prices? Well, I'm not going to make enough money. I have to sell more. Here, if I sell 20,000 units, we're losing even more the more units we sell at 125 and 175 and 200 because these are all you're selling for lower than your contribution margin. So let's say 200, 250, 275, 325, 375. Okay, now look at the differences. So now at $325 a unit, you're making between $593,000 and $4.6 million profit in this period at these different unit sales amounts based on the fact that you produced 50,000. You can produce 50,000 within this period. Let's lower this down. Oh. Okay, here we can sell as little as even 5,000 units, and we're still making a profit at 275 a unit priced. Okay. Now, the last thing, so we've went over the whole model. Let's look at um, the break-even price. So here it's saying, based on this units produced and all these other assumptions for your costs, at 4,160 units produced, your break-even price, no, sorry, at $261 based on 50,000 units being produced, you can sell at $261.88. So if I go here and copy this into here, now as soon as I paste this into here, this number, this break-even units produced, is going to jump up to 50,000 because this is my break-even at 50,000 units. So I can plug this into here, and now look, 50,000 is now my break-even units produced. Okay, now if I lowered this to 20,000 units produced in the period and sold, my break-even units produced is still 50,000 because it's based on this price primarily. But now my break-even price is 263. If I were to put 50,000 back into here, right now see, this is where I'm confusing myself. So we're break even here. Let's go back to, let's say 20,000. Let's say this is $50, or let's say 500. Okay, so at $500 a unit, I only need to produce 248 units to break even. $49. And now my break-even price has solved for what it is here, because I already I knew that at $500 it told me my break-even price, so I put it in there, and then the break-even price solves for this. So it's a little bit kind of, it's not circular because there's no circular reference errors, but it is kind of like one informs the other, but it's still useful to have both of these calculations. To me, one of the most important takeaways of this is the break-even units produced, which tells you how many units you have to produce here, and holding all else true, how many units do you have to produce to at least break even. And obviously you're going to have to sell that many. And that's an important number. Now, interestingly, so if we change the price, so say 300. Okay, right. Our break-even price here should not change. 250, whatever, 1,000. Okay, and then if I put in, say $75, let's say put this back to 8,000. Okay, changing the units sold affects our break-even price here. But really, this is telling you the break-even price when break-even units are reached. And our break-even units, well, it's a negative here. We are selling for less than, let's put this at least to a positive number. We have variable costs, so that hit, okay. So now if I change this, now it's not changing, okay. 50, 275. Sorry, if I change this, our break-even price, I'm trying to figure out why is that correct? The break-even price when break-even units are reached. If we change this, okay, so that doesn't affect it, which is correct. So the price, but if I change the units sold, it's affecting the break-even price. This is a big complicated thing because we have to account for this variable selling cost, and we don't want changing the variable selling cost to affect the break-even price because it shouldn't. But the units sold, I guess if you make the units sold exactly the same as units produced, I'll put this into here. Okay, that gets you right to break even. But what if you put 4,000 units here? Now it's 275. Okay, no, that's not the break even. So this is the break-even price when break-even units are reached. So you have to put in the same units sold here, and then that's going to give you your break-even that you have to charge. Now it's going to be, no matter how many units I put in here, I can put in whatever amount. Doesn't matter. $260 is that? Yep, that's still 0. Okay, so this is one of the most challenging parts of building this, was this break-even calculation. I spent hours trying to figure out how to make it make sense. So it's changing if you change units sold. The number that makes the most sense is when your units sold equals units produced, you're going to get a number here that when you plug into the price, it's going to give you a $0 operating income. Now, I believe that's because this operating income is based on units sold. So, and this is solving for the break-even when your units, break-even price when break-even units are reached. So this unit sold has to equal this for that to be this break-even price to make sense. Otherwise, it won't, because obviously at 5,000 units sold, this is not the right break-even price. If you produce 10,000, sell them for 272, or sell 5,000 at 272, you are not breaking even. You can see here, if I put this in, we're making $17,000 profit. Our break-even, our true break-even price, well, this says 272. What are we referencing here? Oh, because I just pasted that in. 280. Here's the break. So the break-even check. What am I doing with my break-even check? So this is just summing up all the top numbers. This is whatever I put in for my price. Oh, okay. Yes, because this is a new break-even units produced. So here at $285, and these are not directly related. These two are not related directly. So at $285, 5,000 units produced. My cost, based on my cost per unit, I have to sell 2,449 to break even, and that's what this is saying. Because this is my cost per unit, or my selling price. These are all my costs, and this is proving that that does break even at this if you produce this many units. So I could go here, put that in, put it into this, and this goes to 0, matches up with what this was. And then separately, this is saying, okay, what if we change this to 7,000? Well, now to break even, I need to charge 285. I am charging 285. 7,000. No, see, now you need to charge 269. And now 7,000 is my break-even units, which is what this is. Because that was telling me at what price do I need to charge if I produce that many units to break even. Okay, so you can have fun with this. Work the logic. This, if you're trying to learn manufacturing costing, this is a great template to start. Especially this stuff down here. I mean, really the main thing, get comfortable with absorption costing and the cost per unit and how that works, and really study it. And then you can get into the profit and loss and break even stuff after and see how that kind of relates and everything works together. But I imagine people are going to have a fun time with this template, and I will post on the site. Let me save that. So I'll just keep this filled out version I have here on as the default. Now, if you want to download it, let's go over to smarthelping.com. It's going to be included in two places. One, we go to the home page, go down to the accounting. It's going to be in here under calculators, and I'll probably label it something like absorption costing model. I'll go into here. It's similar to, we did a activity-based costing model right here a while ago, so it's kind of similar to that, but it's different, and it goes a bit further. But this is good as well, activity-based costing. So it'll go in the accounting tools. It will be added to the manufacturing bundle as well. So if we go look at the niche template bundles on the sidebar, manufacturing, I will add it into here. By the way, the activities-based costing model should be added in here as well. I'm surprised it's not. I guess I did. I just put it in the accounting. I'm going to add that to the manufacturing bundle, though, as well as the absorption costing we just went through. So both those will be in the manufacturing. Then, because this does have a sensitivity table, I do have a bundle for those things. Let me see where it is. Data tables. So it will be in here as well. Financial model sensitivity table. To find this, you just go to template discounts, pre-configured, and it's at the bottom here. And actually, I got to adjust the price on that. It's $149 now. Alrighty. Well, that's all I got for you. You can always hire me, $275 an hour, if you want some custom work done on spreadsheets for your business or a financial model. You can also buy the Super Smart bundle down here for $4.99. Get every single template on the whole site. We've got well over 200, and you go to the financial models tab at the top here if you want to look at everything I've built. A lot of startup financial models for different industries, but I also have like accounting tools like you see today. A few of those. A lot of stuff in the SaaS subscription membership business model. A lot of real estate underwriting things. Joint venture, cash flow waterfalls, general business valuation, accounting templates. That's kind of what we focused on today. So have a look through the site, and I'll keep on keeping on, and see you on the next one. Like and subscribe.